Okay, there we go. Hopefully you guys can hear me and see me. I'm using a little bit of a different mic than I normally do. So welcome everybody to Trading Coaches Trading Coaches Playbook. And my name is Brandon Wendell, as you can see on the screen. Great, 5x5. Good. Well, welcome everybody. And before we get started, just need to remind you that we are not broker dealers or investment advisors. We are just looking at this information from an educational standpoint only, not telling you to buy, sell, or hold any particular securities, giving any personalized recommendations. There's always risk in the markets, and we can try to limit the risk, but we can never eliminate it. And we are also not subject to trading restrictions. So we can have a position in a security or initiate one at any time. So that being said, there's a lot of stuff going on here at Wealth Builders HQ. As you can see on the screen, we have a full packed schedule, which is a lot of fun. There's a lot of stuff going on. My programs, I've got the SPX Cash Flow Secrets. I actually have a Q&A session coming up as well pretty soon. I do the E-mini Think Tank 3 days a week, Monday, Wednesdays, and Thursdays, where we get to trade the futures markets, both on a day trade and a swing trade basis. So be sure to check that out. With all these programs, I do want to mention we do have a basically 2 weeks free. You can try it out, kind of kick the tires, if you will. And there's no obligation, no stress. If you like it, great. Stick around. If you don't like it, no harm, no foul. So good morning, Helen. Good morning, Paul. Good morning, Stephen. Good morning, Kevin. And Jim, welcome. And Brenda. So welcome, everybody. Got a big group here, a lot of people here. It's good. Anyway, you can always stay in touch with us. I have my own social media as well, so you can follow me, but you also have the company ones that are there, as you can see. And let's see what else we got. I mentioned the programs that I am in charge of. Actually, there's 4. I always forget about the Futures Boot Camp. If you're brand new to futures trading, you want to start there. Gives you the foundation to be able to trade the futures. And then if you want to move on, I have the E-mini Think Tank, where I spend a majority of my time identifying trading opportunities. We had a great one on Thursday. Obviously, yesterday the markets were a little volatile, but we were able to enter a short pretty much near the high on the NASDAQ and caught that big move almost all the way down. We didn't catch it at the bottom, obviously, but took a pretty good profit out of that big chunk of the move in the markets. And we do that quite often. As a matter of fact, let's see. I think I have the returns. I'm not sure. I got to check to see if we closed our Mexican peso trade. There's a swing trade on February. We had, a lot of opportunities, but not all of them get entered, as you can see. I track everything we do. So we had 22 winners, 8 losers. So the win ratio was decent, but I'm not proud about this. I got to fix this. Normally my average win is much bigger than my average loss. And I got a feeling, I don't think I've added all those in. So I got to make sure that the data is updated. But if it is, I had a couple big losses this month, but because there were very few losses, it worked out. When it comes to trading, you got to work on either having a high win percentage or a high average win versus your average loss. So you can actually be negative on your number of wins versus your number of losses as long as the average win is much larger. And that's typically what I see when it comes to my trading. So this is, not unusual. It happens from time to time, but because I had a high win percentage, it made up for the bigger losses this month. So anyway, let me get back over to where I was. Again, if you're interested in learning more about the E-mini Think Tank, let me know. I'd be more than happy to share some information with you and give you the links to be able to log into that. I think our support might do that as well. Anyway, today we're going to talk a little bit about trading gaps. And I mentioned in my social media today, part of what I did seems like a lifetime ago. I guess it has been. It's been 26 years, but I used to work at a brokerage, Lloyd Wade Securities. And I was in their California Carlsbad office, Southern California, and I was what they called an agency desk operator. So I would get to my desk, usually right around 8 a.m. in the morning. Well, that's Eastern time. It was like 5 a.m. California time, unfortunately. But I'd roll into work, and basically we had all the orders that were coming in from our customers. And the broker, obviously, at the time was getting paid by commissions, number one, but also getting filled at a better price than what they gave to the customer. And it's perfectly legal, unfortunately, for them to rip you off. That's really what it is when you think about it. If they're getting a better price, they should just pass it on to you, the customer, but they don't do that. They get to keep the difference. And a lot of times the difference is just the spread, which is the difference between the bid and ask. But it could be much, much worse if there happens to be a gap forming in the markets. So I was dealing with these, what they call market makers. So I was not a market maker. I just want to make that clear, but I dealt with them. So I was sending my orders in and dealing with places like Southwest Securities, PERT, and a few others. So you got to imagine, I wasn't alone. There was thousands of brokers, tens of thousands really, all over the United States and even the world, who would receive a lot of orders from customers in the after hours. And what they needed to do was get those orders completed at a good price as soon as possible. So, there's a lot of gaps that are out there, and these are caused by the action from those market makers. What they're trying to do is basically, well, let me go here first. And by the way, this information can be used on either stocks or futures. We don't really get gaps on Forex because it's pretty much a 24-hour market. Futures technically are nearly 24 hours, but you can manipulate the data to look at something called regular trading hours, or RTH, versus extended trading hours. And that kind of creates a synthetic gap, if you will. So I'll talk about that. But let's first kind of examine why gaps are formed. And I'm going to go to, oops, I was working on my spread building here. So let me close some of the stuff out. Here we go. And here. A little choppy today in the markets, isn't it? This is the ES. You can see we've been back and forth. Not surprised after the big drop yesterday, but let me just go to a stock like Apple. And I'll go down to a 5-minute time frame and clean up the chart. There we go. So when we're looking at this chart right now, we're looking at the regular trading hours for Apple, which are from 9:30 in the morning till 4 p.m. Eastern. However, trading actually occurs well before that and well after that. So if I take this and change on the settings, I think, let's see here, symbol. Yeah, there it is. Instead of regular trading, we look at extended trading hours. And I think it can be changed in the background here. Let me make sure. I don't want too dark, but I want to stand out a little bit. Yeah, it's a little lightly shaded there. So now you can see that, after 4 p.m., there was a bunch of trading going on. And the trading actually lasted all the way until 7 p.m. right here. And then the first trade in the morning happened at 7 a.m. Eastern. So what the heck happened? If we just looked at the regular trading hours, we closed and then reopened the next day at a slightly different price. We didn't really have much of a gap here. It's not too dramatic. This one's a little different right here. So we see that this was the closing price, 4 p.m. on Wednesday. And then the open on the next day, looks like it's right here. So we had a slight gap up. Now, why would we have that gap up? Well, as you can see, there's trading that occurs after the market officially closes and before the market officially opens. Well, who's doing that trading? Well, it's any number of people. Typically, it's going to be professionals kind of setting up their trades for the day. You got to realize in the case of Apple, when it's gapping up, it's often because the market makers and the agency desk operators like myself were coming into the office and seeing a huge stack of buy orders coming in. Well, in order to get buy orders filled, you need a seller, right? Somebody has to sell for every stock that's purchased, and vice versa. We need a buyer for every seller. So if there are no buyers or are no sellers, the market makers become the buyer or seller of last resort. They go in. That's why they're named market makers. They make a market and create liquidity. So they do that by taking the contra for the trades. Well, they're not in the business of losing money. They want to make money, obviously. So what they can do is before the bell rings, they're under no obligation to fill their customer orders until 9:30. Okay, so if they buy prior to the market opening, they can sell to their customers at the open. Now they got their customer order filled. They made the commissions for the company, but they also made a profit because they were able to buy at a lower price and sell to the customers at a higher price. The other thing they will try to do is, if they're not trying to build inventory to contra their customers, is that they may be trying to push prices up to an area of supply or down to an area of demand so that way there will be enough orders to fill their customers. And obviously, it's not just one broker that's doing this, it's many of them all across the board. So that's what causes a lot of these gaps that you see. The gaps up are the market makers and brokerages positioning themselves so that way when the market opens and all that flush of buy orders comes through, they're selling out of their inventory for a profit. Or if there's a gap down, let me see if I can find. Oh, here's a gap down. Yeah, it didn't gap much. I want to see something more dramatic if I can. There we are. So here's a gap down where we have prior day's close, new day's open. It's actually right there. And you could see that there was some activity here because if there's selling going on by the novices, the professionals will have to buy from them or buy to cover their shorts that they made at a higher price. Now, this one wasn't as successful. It's not always going to work for them. You know, there may be one or two brokers that have more orders and can control the market a little better, but typically it's going to be pretty similar all across the board where everybody's doing the same actions. So now you know a little bit about why these gaps are caused. Often, again, it's the market makers try to position themselves to have inventory that they can offload to their customers at the opening bell, or they're trying to push prices into a demand or supply zone so that way when the market actually opens, there's opposite orders to fill their customer orders. You know, in this case, we see that we gapped down and ended up bouncing once all the customer sell orders were filled. Well, if we go back in time, I'm not sure if we're going to find, it's not really a great demand zone, but often you'll find demand in that area. I mean, you can see that's an area where there was definitely a lot of buying pressure. Actually, that's pre-market as well. Should take it off that pre-market there, but settings again. Why are the brokers required to sell during regular trading hours and not required after hours? Because their market making duties only are required during those regular trading hours, period. They're not required to honor their quotes. They don't have to put in quotes or do anything prior to the regular trading hours. It's just the way that the rules of the exchange are written. So yeah, it was near a little bit of a buying pressure area, but it wasn't exactly at its own. So that is why it happens. Yeah, if you take a look, I think it's, not sure if it's under NASDAQ Trader, but trying to think of where you'd find the rules for market makers. You know, NASDAQ Trader has a lot of information, but let me see. You know, if you look up market participants right here, MPID, this market participants ID, you're to type in a stock, perhaps. Not sure if it'll do it by stock. For instance, Apple. No. Let me see. Stock, Apple. I'm just trying to see if it lists the market participants for that stock, but I guess it doesn't. It will somewhere. I just don't remember how to find it right this moment. But if we go to something like, I think it's GSCO, unless they changed. Yeah, there's Goldman Sachs, market participant type. It's an M, that means market maker. So in here, I'm sure if you do a search, there's probably rules for the market makers. Okay. Now, good question just came up. What do I mean by supply and demand? Well, supply and demand are something that I like to use that's a little bit different than what most people are used to. Most people look at what's called support and resistance. And I really don't follow that. I don't prescribe to that. What I'm looking for are pockets of buying pressure and pockets of selling pressure. So when I go to my E-mini Think Tank members area, I can't go too much into detail at this moment, but inside, I think, yeah, it's under, well, videos. I actually have videos on it. Let's see, where is it? I have stuff on the gaps as well. Where the heck is it? I know I have something in there. Choose the right targets. I think, oh, there it is. Trading routine and finding zones. So I have a recorded lesson for my students for the E-mini Think Tank that actually goes into detail. And also under documents, there's a document that supports that as well and walks you through step by step right here, leg-based zoning technique. So basically what I'm looking for when it comes to turning points in the markets, I'm not looking for your traditional support and resistance. I'm looking for an order imbalance between buyers and sellers. So there's an order imbalance where we have lots of buyers and very few sellers. There's a pattern that typically appears on your chart, and that's what I call demand. This one, it's not really a good one here, but you can see that prices stopped dropping and rallied. Well, why would that occur? It occurs because of an imbalance. There are no more sellers, but there was an interest in buying, and somebody might have had a large buy order. So that could be identified. It doesn't quite meet my criteria, but it's an area where there's a lot of buying pressure, but not a lot of selling pressures. So we're likely to see prices reverse there again in the future. And the same thing, a supply zone is where you have that imbalance where there's lots of selling pressure, but no buyers to hold up price. If there's evenly matched buying and selling, prices pretty much go sideways. And that happens, not forever, but it does happen. And, when we have that imbalance, that's where you see those changes in direction. So if you know what the patterns are and how to find them, you can predict where prices are going to turn before they do. And obviously that's very useful for traders. So when I subscribe to that supply and demand facilities, the start or reversals of trend and support and resistance facilitate the continuation. I'm not sure about that. I mean, the one thing I really don't like when it comes to the definitions of support and resistance is that they often say that if an area is tested multiple times, it becomes stronger. And to me, it's completely opposite. We need to have that imbalance. If an area is tested, the more times it's tested, for instance, this little buying pressure area here, the first time you're there, there's a big imbalance and we had a pretty good bounce. And what happened was, though, a bunch of the buy orders were filled. So there should actually be less buying pressure in the future. Well, we came down, we ended up bouncing again. That was fine. But here we are again. And excuse me, notice we went a little deeper this time. And part of the reason why we're going deeper and may not bounce as well is because we removed a lot of the buying pressure. But when you're looking at support and resistance, they would say, oh, this is a great support level and it's being confirmed over and over and over again. Right. So I don't really prescribe to support and resistance whatsoever, according to the classic definitions. So that's why I stick with my supply and demand. It works out really well for me, as you saw with the results from the E-mini think tank. So great questions, by the way. Kind of getting back here to the trading the gaps. Basically, again, excuse me, a gap is a break between prices, where security makes a major move up or a major move down. And honestly, that is a huge imbalance when you think about it. If prices make a big move up or a big move down, that's because there was no opposing pressure to hold it. Oops. Sorry, my cord is getting caught here. I'm not used to this one. So anyway, when you see a big move without price action happening, that is a gap up or gap down, and it's how the markets sort through a large imbalance. Whoops, sorry. So they get created by news. Obviously, when you have big news like we had this morning, as a matter of fact, we had the non-farm payroll numbers coming out, and that caused reactions, obviously, and we have gaps because of that. It can also happen on a regular day just because of normal buying or selling pressure that comes out from the customers, or even changes in analyst outlooks. You get upgrades and downgrades that could actually cause an imbalance in orders. Nobody wants to be owning a stock that gets downgraded by a bunch of major analysts, obviously. So when it comes to the gaps, you can see them on daily, but it's not as easy. It's better to look at intraday timeframes, and really to see the gaps kind of pop at you and really stand out, you go down to 5 or 15-minute time frame. So they'll appear on pretty much any time frame. We have a slight gap down on Apple. Let me see what Tesla looks like. I don't know if we had any big gaps today. No, not really. This was a gap. You can see we closed, opened down here, but it almost is hidden when you're looking at your charts unless you know what to look for. Obviously, if I put in a separation where the end of the day and beginning of another day start, this is easier to see when there's no price fill when it comes to that gap. Okay. But if you go to a daily chart, they're going to be much more difficult to see, but really a gap, these are gaps, obviously. But a gap is any time you open somewhere different than where you closed the previous day. So this is a gap up. We have a green candle that closes at the top of the body, and we have a red candle that opened higher than where we closed the previous day. That's actually a gap up that filled very quickly. So some of the gaps are a little more obvious than others, but to really see them better, dropping down to smaller time frames will kind of point them out a little bit more for you. But it's whatever you feel comfortable with. There's not one perfect timing or time frame for everybody. You got to trade what time frame you feel comfortable with. So I identify really 4 main types of gaps. And, some people may identify different kinds. I've heard exhaustion, continuation. I don't really look at those too much. I misspelled sell and buy there. I didn't realize that. Anyway, but the 4 main types of gaps I look at, and it comes down to how they're caused and who causes them, as well as physically, what are their attributes. So we have what's called a novice gap. And a novice gap is often also called a continuation gap. So a novice gap is when you gap in the same direction that the trend was already moving. And it's called novice gap because it's typically the novices' orders that are gapping in the same direction. They're trying to play catch up. And professionals tend not to chase price. They wait for prices to return back to a level that they want to enter or exit. Well, novices, they get that emotion. They feel they're going to miss out if they don't jump in right away. So they get in after a move in price, which usually doesn't work out too well. So novice gaps are typically in the direction of the current trend. They do tend to close very quickly because often it's the end of the move, right? Because again, those novices are chasing price. They usually will not act as supply or demand. So when the gap closes, often it will continue beyond the gap. So you will not usually get a gap that, again, a novice gap, when it closes, it doesn't turn around. It actually keeps going typically. Again, not always. Just so you remember, there are always exceptions. Nothing in technical analysis and charting always happens. All right, so you got to be aware of that. That's why we play the highest probability, but we're not going to be 100% perfect. Nobody is. Okay. All right. So here's a novice gap. Again, just an example where we were moving up in trend. And it's not just the end of the day. I'm talking about the overall trend, and we gap in the same direction. That would be a novice gap. Again, it's people trying to chase price, and they usually catch it right near the end of the move. A professional gap is a little bit different because that is typically a gap in the opposite direction of the current trend. And it's because the professionals are trying to get in at a good price, but there's nobody that wants to take the opposite side of their trade, unfortunately. So they have to gap the price to where they can find someone to take the stock off their hands or to sell them stock. So those professional gaps usually do not close right away. They're kicking off a new trend with professionals, and they tend to stay open for a little while. Again, not always, but often. And when the gap tries to close, or when prices come back to try to close the gap, meaning it tries to come back to the prior close, they will actually use or work as kind of a bouncing point as supply or demand. So once you see a professional gap closing, usually prices will reverse once the gap is closed and then continue off in the new trend. So here's a pro gap. We were moving in an upward trend, but at the end of the day, we gapped down on the next morning. You can see as we came back up, we actually didn't close the gap fully and continued down. Okay. So again, the pro gaps usually will not fill on the same day. Once they do fill, typically it'll cause price to reverse once again as the pros again come in and try to push that price. So if we go back to Tesla that I have here, and just go back randomly to way back and just kind of see what do we have here. Well, we don't have much of a trend, kind of choppy and sideways, so we gap down. Not sure what I would actually call that one. Here you can see we were gapping down, or sorry, trending down. We gapped up. Okay, so that's a pro gap. However, we closed the gap very quickly and kept going. So there's an exception. Remember, it doesn't always happen, unfortunately. Go a little bit further here. We have another gap up. Didn't really have much of a trend, but overall still bearish. So closed it pretty quickly. another gap up on a downtrend. Once again, we did bounce initially as we tried to close the gap as the buyers were coming back in and pushing back up, but it gave up pretty quickly. And here we're again moving in a bit of a downtrend, gapping down, tried to close the gap, but this novice gap didn't close, and it did actually cause prices to continue down. So like I said, it doesn't always happen with the pro versus novice. And honestly, I don't put as much weight on pro versus novice as I do the other two types of gaps. And you can see why, they don't always work. So I got a lot of exceptions there. I don't want that many exceptions. So the other types of gaps that I look for is an inside gap. And these are based not on who causes them, but they're based on the physical attributes of what happens with that type of gap. And an inside gap is often ignored by a lot of traders, to be honest with you. They don't follow these very often because it's a very small gap typically. And what happens is the current open for the trading day is either above the prior day's low, or sorry, it's not either. It's above the prior day's low and below the prior day's high. So we basically have gapped inside of the prior day's price action. So it's an inside gap. You didn't go beyond the prior day's price action. You were within it. And they usually close pretty quickly. It's not always going to happen in the first 15 to 45 minutes, but they at least try to make a move to close those gaps pretty quickly. So, if we have, let's see, do I have an inside gap? Here we go. I do have an example. And we'll look for some of these, obviously, and see how they work. But you can see on this particular day, we had the low of the day, high of the day that were formed. And when we gapped up, we are below the prior day's high, above the prior day's low. So that is gapping inside of the previous trading day's price action. And try to move a little bit, but then ended up closing. Or in this case, again, we have the same movement, but we gapped down. We didn't gap beyond the prior day's price action, though. We're above the low and below the high. So we gapped inside of the prior day's price action, and we closed the gap relatively quick. So usually what I'll do is I'll look for an area of supply or demand that's going to cause prices to start moving to close the gap. And if I can find it, great. If I can't, well, then I just don't get a trade. And again, we can do this on futures just as easily as we can on stocks. You just have to make sure you're charting regular trading hours only. So let me go ahead and show you what I mean by that. If you go out to something like bar chart, if you're not familiar with the RTH or regular trading hours, bar chart, you can go to the futures tab right here and contract specifications. Now, not all futures will have regular trading hours. Okay, you can see the currencies pretty much don't. But when you go to some of the securities such as energies, now you see, so zoom in a little bit. There it says RTH. So those are regular trading hours for crude oil. It trades 23 hours a day. It opens at 4 p.m. Central, closes at 5 p.m. Central. Technically, I'm sorry, 5 p.m. Central Sunday until 4 p.m. Monday, and then again at 5 p.m. and so on. But the RTH or regular trading hours are from 8 a.m. to 1:30 Central Time. That's the old pit hours that they used to have in Chicago. So those are considered the RTH or regular trading hours. So if you change your charting to where you're only looking at those regular trading hours, you will actually see gaps on futures like crude oil or anything that has regular trading hours. So if I go over, for instance, CLJ, this is crude oil right now. Let me clean this chart up. And currently it's showing all of the trading regular hours. So I'm seeing after hour stuff there, 2, 3 in the morning. However, if I change my settings, they call it electronic trading hours and regular trading hours. Notice now we see a lot of gaps. All we're doing is just cutting out the data that occurs before 9:30 Eastern, right there. And after should be 2, they got it wrong actually. Look at that, it's at 4 p.m. that they're using. That's wrong. It should actually be cutting off at 2:30 in the afternoon officially. So they're showing some extra data here, and you could probably change the hours, customize it to make sure that you're looking at the right hours. So yeah, it's probably a way to do this. I just don't know how to do it off the top of my head right now, so I'm not going to worry about it. But anyway, you can see the gaps where you normally would not. And again, we can look for inside versus outside gaps on multiple securities. So looking at crude oil here, we see, well, prior day, I'm on a 15-minute chart. So we have, I think that's the low and the high. And of course, first one I pick, outside gap, it stalled at the prior day's low, but eventually closed the gap. Here we have another gap. Big range on that day, but you see we gapped down. We are still within the prior day's price action, and we closed the gap. So inside gaps, again, you're just opening up within the prior day's price action. They typically try to close pretty quickly. If you can get a trade off it, great. If not, just wait. Now, the opposite gap that we just saw, actually, and I forgot to mention it first, is an outside gap. And these are a little more significant. With the outside gaps, the open for the current day is either above the prior day's high, so we're gapping above the high that we had the prior trading day, or we're opening below the prior trading day's low. So we are gapping outside of the prior day's price action. Those gaps usually don't close on the same day. Notice I'm not speaking in absolutes because there's nothing that's absolute in trading. Sometimes they will close, as you saw. But here we have an outside gap where we opened up above the prior day's high, and it did make a move to try to close the gap, but couldn't close it. Closing the gap would require it to go back to the prior day's closing price and trade there. Or in this case, we had a gap down that was below the prior day's low. So that is an outside gap, and it couldn't close. So again, if we go back to my chart here on crude oil, day by day, just keep looking, putting a line at the high, a line at the low, and we see that that gap down, but it did not exceed the prior day's low. So it's an inside gap, and they have a high propensity for closing, meaning we should trade back up to the prior day's close. In this case, we did not. That was actually a big sell-off day there. Now we have another gap. We got the high and low. We are opening below the prior day's low, and therefore we have an outside gap that if it does come back, it may not close. It may end up wanting to reverse and move down. Well, it did close, but it also reversed. Next day, opened up with an outside gap. Here's the high and the low, and we know what happened yesterday. Definitely closed. So not always the best example there. Again, I can go to Tesla, make sure I'm looking at the correct trading hours. Regular trading, good. And just going back to a random date. We'll start off looking right here. We see a pretty big gap, obviously, to the upside. Prior day's low, there it is. So that's an outside gap, obviously didn't close. Nope, actually I had the wrong day here. It's too much. That was it. On a daily chart, well, again, we're not going to see the gaps as well on the daily chart. It's going to be much more difficult to identify them compared to intraday charts. So what I'm trying to do is just show you the examples of the different types of charts right now. Okay, so where was I there? There it was. And moving forward here, we got this day, high and low. And you can see that was barely a gap above the high, but it was an outside gap. I'll zoom in more so you can see that better. And we didn't close the gap. It bounced off the prior day's high. And there it went. So the end of the day, didn't really have a gap on that day. So move on. There we have another day right there. And let's see where's the morning there was. So high and low. Believe it or not, that's an outside gap. It's just a very small gap though. So, it may not have had much consequence to it. It was outside, but we closed it very quickly. No gap on that day. Some are a little more obvious than others, like this. There's the high and the low of that particular day. Outside gap, if it does come down, it may bounce from that high, but it didn't even try. Oh, it did. Late in the day, look at that. It came back and bounced from that area. So anyway, inside versus outside gap. Okay. Yeah. Like I said, if we go to a daily chart here, everybody's always interested in certain securities and seeing what's going on. You can see that, some of these gaps are really, really big. Some of them are not as obvious. And in this case, we've actually had continuation gaps to the downside and multiple ones. So it's kind of interesting. All right. And there. So, like I said, those are the two gaps that I typically kind of follow a little bit more than the pro versus novice, but you can kind of combine the two and increase probabilities that way. So remember, the novice gaps usually do not close. I'm sorry, the novice gaps usually do close very quickly, but so do inside gaps, right? So if you see a novice inside, it's likely to close the gap pretty quickly and it's likely to keep going. Again, we're trying to increase our probabilities for our trading by identifying what is happening on our chart and what is most likely to occur based on who's causing the gap and what kind of gap it is. So on the opposite side, if we had a pro outside gap, that is the least likely to close. You can see they're on the two extremes here. We have the inside novice, closes very quickly. Once it closes, it usually just keeps going because they're very weak and price usually ignores them by closing the gap and punishing the novices that were chasing price. But with the outside pro gap, those are usually your gap and go, where we're gapping in a new trend direction and outside of the prior day's price action usually doesn't fill right away. And even if it does, it usually bounces. Okay. And I don't know if I mentioned it or not. Let me see. I'm trying to check my slides. Oh, okay. It's coming up actually about trading these a little bit. So, when you start mixing the types of gaps, inside novice, outside pro, those are the two strongest, the two extremes. But if you have an outside novice or an inside pro, well, now you're lowering your probabilities. And that's where you're seeing those failures of some of those gaps. But again, even though it might be a very strong outside pro gap, it could still fill. This is the market. It could do whatever it wants to do. The market can be wrong more than you can stay solvent. I don't know if you've heard that quote before, but that's out there. Again, you got to make sure you let go of your ego and just listen to what the market's trying to tell you. We can find or try to figure out the highest probability of what will happen. But at the end of the day, the market is always right. It's going to do what it's going to do. And we just need to try to figure out what it's likely to do and get in front of it. But if we're wrong, take the loss and move on. Keep them small. So, trading the inside gaps. Okay, remember the inside gaps tend to fill very, very quickly, usually within the first 15 to 45 minutes of the trading day, depending on the regular trading hours. Let go of your ego. There you go. Set it free. So if we happen to have an inside gap up and we know that's likely to fill, I'm going to look for an area of supply, again, that imbalance. And if you want to learn more about what that is, of course, you can go to the E-mini think tank and I have the lessons that teach you exactly what we're looking for those supply zones. But with an inside gap up, I look for a supply zone to be able to enter a short for the gap to close. And my target will generally be initially the gap closure. But because if it's not only an inside gap, but a novice inside, we might keep going. There's no reason to give up the rest of that profit. So you can just let a trailing stop take you out eventually. Or if we have an inside gap down, I'm going to be looking for an area of demand where I can buy. I don't just blindly get in at the open, because, we got to make sure it's going to turn. So I look for a zone, a demand zone in this case, where I can buy, targeting initially the gap closure. Once again, if it is a novice inside gap where we're gapping the same direction as the overall trend, we're likely to go beyond the gap closure and we can get bigger profits that way. So let's see if we have any examples here that we could use. Again, I'll go down to, say, a 15-minute. And actually, let's go to QQQ. Just change the securities here a little bit. There we go. I'm on a 15-minute time frame. And again, I'm looking for inside gaps, but of course, I see a bunch of outside ones. All right. This one's inside. we see the prior day's high right there and the prior day's low right there. That's from the 20. No, it isn't. Take that back. These are different days. That was an outside. Actually, what I should do is, oh, where is it? Session breaks. I think that's it. Yeah, that'll help me with the days. Now we can see it a little bit easier, right? So again, nothing but outside gaps here for the most part. Here we have one inside finally. So we have the prior day's high, prior day's low from the 14th, and we had a small gap down. Again, we know that that's likely to fill. In this case, it wasn't really a great area of demand, but we do have the origin of this buying pressure just after this little pause. So if we had bought here, started to close the gap right away, actually did right there. Remember, the gap closure, is price going to the prior day's close. So if you had gotten in pretty much near the open, you hit your target. And because you were really close to the bottom of this zone, you could have had a nice tight stop loss, and reward was about 3 to 1. Matter of fact, if I go down to a 5-minute time frame, might be able to see a little bit better as well. Let's see, going back, there it is. And you could see that we could have tuned this, or fine-tuned a little bit more there. You had this little drop, base, and rally that started that move. We opened up right in that area. So you could have entered targeting the gap closure. And you can see as soon as we closed that gap, it actually reversed. And well, I don't know what the overall trend was, but you can see for the most of the day, we were going up. We gapped down. So that's a pro inside gap, which means we close the gap quickly, but then we turn around there and eventually went a little bit higher. So that was an inside gap that gave us a trade opportunity. Let me clean this up. Go back. Another one right here. We have the prior day's high. Come on. Prior day's low. Where's the close? There it is. So we closed. Here's the gap closure. Let me change the color so it stands out a little bit more. Anyway, we opened here inside of the prior day's price action. Unfortunately, you might have been stopped out on this one if you got long right away. You can see it opened just above this area of buying pressure and went down a little bit all the way down to the beginning of the prior day's rally, which in itself was also a zone. Just barely tagged that and closed the gap. Notice it paused when it closed the gap before continuing. But it was an inside gap that closed. You might have just been stopped out on the entry, unfortunately. Doesn't always work out. And going back a little further, and it was not much of a gap, but it was inside. Come on. Keep missing the button here. I'm moving too fast. That's an inside gap, right? Inside of the prior day's price action, closed the gap, and then continued on. Another inside. Right there, opened up pretty much at the prior day's highs and immediately worked its way down to close the gap and actually test the prior day's low. So here's a failure for the gap to close. We have the prior day's high, the prior day's close right there, which would have been your target. And you can see we opened up, moved down into this little demand zone. That would have been your entry right here. Oops, move that down a little bit. There you go. Now you can see it better. So we have our open, moved down into the demand. That would have been the long entry. It started moving up, but it failed to close the gap and then turned around on you. So it would have been stopped out, possibly for a win. I don't know. It depends on how you move your stops. So that's an inside gap. Again, I usually look for a zone. from the prior day or beyond and try to trade it for the gap closure if it's worthwhile. If it's less than a 3-to-1 reward to risk, I typically pass on the opportunity. I got to make sure that my winners are much bigger than losers. Now, for the outside gap, it's a little different. I was just showing some examples there. The outside gap, again, we're not likely to close the gap completely. Instead, what typically happens, the prior day's high or prior day's low usually works as a bouncing point for price. So instead of trading for the gap closure, we could actually look for it to partially close and then continue on in trend. And I usually use a 5-minute candle for the best results. You can use whatever time frame you want. Okay, so as an example, if we have an outside gap up, okay, remember we open above the prior day's high. And it could just be the next day or it could be over the weekend, whatever. But since we have an outside gap up, the prior day's high usually acts as a bouncing point. It's not a demand zone, though. It's not as strong as demand, so you got to realize that. And there's other things that go on with this as well, especially when I'm trading futures, because I use this pretty much nearly every single day when it comes to the equity index futures. But there's some certain things you have to put in place to make sure you have the highest probability and the opportunities. So again, I go over those in the E-mini think tank in a little more detail. So instead, if we have a gap down and we happen to open below the prior day's low, that's an outside gap down, the prior day's low will often act as a little bit of resistance. Okay, not supply. Again, it's not as strong. So it can work as a bouncing point and give you a possible entry for a short. So again, going back to our example here, let's see, we had a bunch of outside gaps here before, didn't we? Up there. Nope, that was inside. No, I saw them. Well, this one is example, but it didn't really work. It tried to. You can see I'm on a 5-minute time frame, right? Yes. This was the low on the 9th of February. That's an outside gap because it's a green candle. We opened below the prior day's low. Actually, yeah, now you can see the entire day. Well, what happened? We bounced off that prior day's low. Eventually, it came back up again and closed the gap, but the initial move was to bounce off the prior day's low, as it usually does. Now, part of that might have been because it was a novice gap and therefore not as strong. Remember, the outside pros are much stronger than the inside. So moving to the next day, that's an inside. Let's find another outside. I know they're there. That's an inside, inside. And that, I believe, let's see. That's the prior day's low. Nope, that was inside. Look at that. Close the gap, almost close the gap. Couldn't quite do it. Now we have an outside gap. You can see we closed pretty much at the low of the day. And we opened outside. Well, I don't know if it made it back up to the prior day. Nope, never did. So just didn't work. Doesn't always. I mean, it stayed open. It did work that way, but it didn't give us a trade opportunity. So here we have another day and another opportunity. That's the low of this Friday. On Monday, we opened below the prior day's low, outside gap. So as we come back up to the prior day's low, there may be a shorting opportunity here, depending on trend and a few other things as well. And boy, was that a nice opportunity. Now, depending on where you had this stop, made you a little nervous, but it definitely worked. Okay. So that's what we like to look for if possible, if we have that outside gap in there. Inside, outside. So this was a huge outside gap. You can see we gapped way, way, way above. Oh, that's not even the high. Sorry. It's over here. That's the prior day's high right there. Okay. Do I trade off the beginning of the open to close gap and also potential reversal? I don't trade the open necessarily for it to come down to bounce. I mean, if there's a supply zone or demand zone, yes. And if I have a good enough reward risk ratio, but no, typically with the outside gap, I'm going to wait for it to try to bounce and take that opportunity. And yeah, it comes down to a few other factors like trend as well. So right there, you can see it tried to bounce, but it failed. So they don't always work. Let's see. That is another gap right here. Let's clean this up and mark off the low. So on this Thursday, we had a price action, big price movement there, gapped down below the prior day's low. And it worked again. We had a nice bounce off that prior day's low to continue that downward move. It ended up getting a bit choppy, but the initial move was a nice profit off that prior day's low. And that's what often happens. Well, here we have another gap up above the prior high. It's kind of a wide range candle there. Let's see, do we bounce? Didn't quite make it. So anyway, that's a little bit on the inside versus outside gaps. And again, how we could trade them. This is on the QQQ. If I were to go out to, let's see, RTY, Russell 2000, we just change our settings to look only at regular trading hours. Good, I had it on there already. And once again, we can actually see gaps this way where we wouldn't normally. So just going back in time, there we go. And sometimes it takes a little while for the gaps to fill. They don't always fill right away. Let me clean this one up again. There we go. So this is an inside, very small gap up, but it turned around and closed. Took it a little while to find some selling pressure. See if we have another example. Looks like an outside. There's our high from this day. This is an outside gap. So as we turn around and try to close the gap, we should bounce. And you can see the initial move was to bounce. Unfortunately, there wasn't a very strong move. We had actually a negative divergence. That's a whole other lesson. Basically, what happened there is we tried to make a new high in price, but we did it with a lot less momentum. So that's why it failed. And it did eventually close that gap. Here we have, let's see, what kind of a gap do we have there? Got the low, and we outside gap there. You can see it's just below the prior day's low. And we moved up and tried to turn around. It didn't really work too well. It probably would have stopped you out, unfortunately. It was very choppy that day. Another outside gap. Not sure if that one even comes back as well. This red line is my RSI. Yeah, if you go on YouTube and search for me, I did a bunch of sessions on the RSI. I actually have lessons on that as well inside the members area here. There's my RSI rules. And I have videos on it as well in the E-mini think tank. So I use the RSI more as a momentum indicator than an oscillator like most people do. And it works. That took all day long. Look at that. But we finally bounced off the prior day's high right there. It was an outside gap up, and it took all day to get back there. But by the end of the day, it finally bounced. And you had to hold it overnight, but it's a nice move. Anyway, so that's a little bit on the inside versus outside gaps. I think, I just had a little example here. Prior day's low, uses the prior day's low as a bouncing point, and then gives you a possible short opportunity there with the stop loss placed above the high of that candle. Or if you have a gap up, right there is an outside gap up. The 5-minute candle is usually what I use, and I use that range for my entry with a stop loss below it. And it bounced. So that's pretty much what I got for you guys today. I was going to go over some of those gaps. Like I said, if you want to learn more about how I trade those gaps and see it in action, I do it 3 days a week. The E-mini think tank has tons of education here. And if you decide to enroll, you get 2 weeks free to try it out without any risk. And you get access to all the education. So you can watch the videos. You can, there's the link for you. Lee just put it up. You get access to all the documents if you want to check it out. And, I had the monthly trade tracker. We track everything that we do. I got to put the February one up there, but we track all the trades, and I teach you how I identify these opportunities, and I walk you through them on a daily basis. Well, not daily. It's Monday, Wednesdays, and Thursdays from 9 a.m. Eastern to 11 a.m. Eastern. And I also send out, let's see if I have it open. Show you some of the trade ideas that we had. There we go. 3.9. I'll show you the most recent one. Well, thank you. I'm glad that you enjoy it. See me saying superb stuff, best out there. What I do is I start off the session with this and I email it out to you as well. It's my trade ideas. So there were trade ideas on a 60-minute chart, 15-minute, 15, 30, and then we had the NASDAQ one that worked. So every session we get together, even if you can't make the session live, you will still get emailed this session or these documents with the trade ideas on those 3 days. So you could use those to learn more about what we look at in the markets. And of course, like I said, as a student of the E-mini Think Tank, you can go to the videos and the documents to help you learn more about how I trade the markets. So if there's any questions, let me know. I want to thank everybody for being here for this session. And hopefully I'll see you in the E-mini Think Tank. Again, Lee put the link there if you're interested in trying it out. For the quarterly subscription, you get a 2-week free trial. We don't charge your card for the first 2 weeks. So there's no risk there for you if you want to check it out. Monthly, you just pay for the monthly subscription. So you're very welcome, Jennifer. Thank you for being here. Thank you, Brenda. Appreciate it. And I know you were dying to see what my opinion was on Tesla for the daily, right? So since you know, right now we're rolling over and we're holding above 40. So on the daily, it hasn't broken to a downtrend yet, even though we are seeing some lower highs and lower lows. We're kind of basing right now at a weak demand zone, which, you know, what I'm seeing right now is likely to go a bit sideways, not really bounce out of here much, but we could get caught in a sideways range from about 173 to 200 for a little while. Now, if the RSI does dip below 40 with some selling pressure, then yes, it'll drop down and close that gap. That gap will not hold as a bouncing point because it is a novice gap. So we could see it go down as low as 120. So that's what I'm seeing right now in Tesla. And as far as the overall markets, if we take a look at the S&P futures, you can see that is very bearish. And we're trading down near the lows. I think eventually we will take out the October lows this year. I do see it continuing. I wasn't expecting to see this much of a sell-off here in spring, but definitely before summer, I guess is what we're trying to push down right now. So going down to the smaller, oops, hit the wrong button there. Going down to the 4-hour time frame there. Oh, make sure I put the right chart in because I forgot I was manipulating this. There we go. Electronic trading hours, so I get everything. I had a retracement set on there because we basically retraced the Fed announcement today. That's all we did. And I knew we were going to continue to move down. It was one data point. That was it. So as you can see, we're continuing to move down. Not sure. Yeah, our next target potentially, is actually this demand zone, 3850 area, 3840 really. You can see there's a 4-hour demand zone, and that's where we're heading right now. Question, okay, how do I identify when supplier demand is satisfied on the higher time frame? Well, what do you mean by satisfied? You know, I mean that's working. If we come to it and bounce, obviously it's showing us that. And I also, excuse me, use the momentum to help me as well. So to know that the trend has really changed, you just look for the definition of a trend. So for right here, we had higher lows and higher highs. So once you break the controlling low, you are no longer in an uptrend. You're not into a downtrend unless you make lower highs and lower lows. And right there, we actually made lower high, lower low, even before we broke the low. So it kind of warned you that that was going to happen just from this. Now, on the daily chart, I'm not sure if that happened at a zone. Yeah, I think it did on the NASDAQ, but it didn't here. But you can see we were at an area of lots of selling pressure, and that's where the trend reversed. But it wasn't confirmed until you made the lower high, lower low after lower high. So right there where that happened, told you that was going to go. And now we're in a full-blown downtrend. So the only way we stop the downtrend is we make higher low followed by higher high, or we break the most recent high. Well, that's way up here, 4080. Not likely to happen soon. And that would tell me that the longer or larger time frame trend has changed. Same thing on the weekly charts. Here on the weekly chart, higher low, higher high, we're in an uptrend on the weekly, but we failed to get into bullish territory on the momentum here. And all we need to do to break that uptrend is break this low. And at the same time, we'll probably also go below 40 on the RSI. So that will tell me that we've broken the uptrend that we are in on the weekly chart that began right here in October. Make sense, hopefully? Oh, absolutely. The small, he said the structure on the 15-minute plays out faster than, on the daily. So you're conflicted on which to use. It depends on what you're trading on. I use a multiple of 4, 5, or 6. I use 3 time frames. Again, this is covered in the E-mini think tank in more detail, but when I'm looking at trading, where does it have here? Oh, it's actually here in the trading routine and finding zones. I talk about how to use the multiple time frames to really understand which trends are going to impact the time frame that you're trading on. So if I'm trading on a 15-minute intraday opportunity, I don't care what the weekly trend is as much. It's way too big. There's other trends that are going to affect me. So again, it's not an easy question to answer, just the time I have here. So speaking of time, I'm out of it, so I got to get going. But hopefully I was able to answer a lot of your questions. Again, if you have more, if you join me at the E-mini Think Tank, at the bottom of the screen here, you can always send me messages. So even if they're not in a live session, I still answer for my students. So I still get back to everybody. So lots of ways to get a hold of me there. If you got more questions about what we went over today, you can also email us at support@wealthbuildershq.com. So I want to thank everybody for being here. Here, I'll type it in. Support@. There we go. So you can get a hold of us. If you got any questions about what went over today or any of the programs, thank you very much. Appreciate it, everyone. So thank you for being here. Trade safe, trade well, everyone. Take care.